Hey traders, Raghee here. We're going to take a look at how the hourly price movement ranges guide us after a big move in the CPI sent indices higher and bonds higher as the year-over-year CPI printed 2 ticks lower than what was expected. 2 ticks lower than what was expected allows equity traders and index traders to presume that the Federal Reserve does not have to be as hawkish. That's going to send yields lower, that's going to send dollar lower, that's going to send equities generally higher. But on a big gap up, whether that be bonds, whether that be the indices, how do we trade it? How do we wait for a setup? And that's where I'm going to wait for the hourly price movement ranges to give me guidance as to where support may be. And a lot of times, it's not a matter of a level being touched and then the markets just take off from there. A lot of times, it's the patience to wait for these zones to be reached. You can see this has happened here about 10:30 today. I'd be open to any of those green zones being hit for an intraday buy based on the hourly price movement range. Now, is it going to be the same with something like the S&P? One of the things that we've been seeing is after an initial quick buy, we're seeing Dow lower, we're seeing S&P lower. Now, this is something we've talked about in these free videos before. When the S&P and the bonds seem to disconnect in terms of bonds are holding strength, but the equities are not, I'm going to then shift away from indices that are not tracking with the bonds. Sometimes I'll shift to the NASDAQ, or I'll just stick with the bond market and focus there, because I'm going to presume probabilistically that if either is quote unquote wrong, it's likely going to be indices and not the yields. And in this case, I'll stick with the bond. So be ready to continue, to monitor the way indices and bonds are moving. And then if they disconnect, clearly that's a really good reason to maybe shut it down for the morning and use that 10:35 Eastern cutoff. If not, sticking with bonds would probably be the better choice. Now, what are other alternatives on a sort of mixed up morning? All right, this is not about, hey, these are the great big winning trades for the day. Although, I've had a couple nice ones this morning, but where can we look when bonds and indices go their separate ways? Go right to bonds, go to euro. Take a look at the euro. As yields drop, oftentimes the dollar is going to drop, and that's going to send the euro higher. So bonds in the euro should move with a positive correlation or sympathetically. All right. The other market that we can take a look at is gold. So please don't always force. I tell myself, Rod, please don't feel the need to force trades in the indices. So if I take a look at, say, gold, if I take a look at bonds, any of these other future symbols that are absolutely tradable for us, I will consider whether or not it makes sense for us to focus elsewhere. And I think a lot of traders just think, I'm going to trade the S&P. Take a look at the Dow, take a look at the NASDAQ. And if those are not synced up with bonds, trade gold, trade euro. Those are going to be excellent pivots, not in strategy and not ignoring structure, but rather in fine-tuning your watch list as the morning progresses. All right, I'll see you in the next update. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.